Hello everyone. My name is Kamal Manocha. I represent PMS AIF World. Another Friday, another webinar, and today, we are going to learn from Anshul Saigal on a very, I would say, simplistic topic, which is actually the cornerstone of the genesis of wealth creation, which is basically valuing growth. Today there are various styles of investing into equity markets. We always keep studying value style of investing, growth style of investing, momentum style of investing, and we keep debating. There are various phases of equity markets, but across all these styles, the ultimate thing is that if you're able to value the growth well, you're able to enter into a stock with a very good prospect. And that is exactly what we are going to learn today from Anshul Saigal, who brings with him 2 decades of experience. He has been working with Kotak Portfolio Management Services as an EVP for last 14 years. And, he's managing some of the very well-known portfolio management services which Kotak PMS offers. So, he has made a very interesting presentation, which I have gone through few slides, which talk about the entire, thought process in a very simplistic manner. And post this presentation is over, we will be taking questions and answers. I can see, we have 90 people already joined in, so it is a good time now. I think we can start. I'm handing over to you, Anshul, to begin your presentation. In the meanwhile, just give me 1 minute. I will just, upload the presentation. Anshul, you can, start the context, and I will upload the
Sure.
presentation from the, background.
Thank you, Kamal. It's a pleasure to be speaking with you and to your esteemed clients. Thank you, everyone, for making the time and coming to listen to us. The endeavor in this presentation will be to give you a picture of how individual stocks offer value, what in individual stocks offers value, what is it that we seek when we are identifying an opportunity, how is it that psychology matters in all of this, and finally, relating this whole aspect in a multidisciplinary manner to other aspects of investing or putting your monies in a risk-adjusted, favorable manner to invest in various asset classes. That is the endeavor of this presentation. And once Kamal puts up the presentation, we'll proceed from there.
Sure, Anshul, just give me 1 minute, because last minute I had to
Sure,
change the machine. I had to upload the presentation once again. Just give me 1 minute.
no problem.
Meanwhile, Anshul, I think you can cover the current views which you would have, or market, or Kotak's views on the markets, because I'm sure investors want to know. This is a Friday and markets have fallen. What is the way forward, maybe, over a near term in terms of valuations? And just give me 1 minute.
Sure. So on the markets, actually, if we look at how the Indian markets have performed over the last, say, 7, 8 months, we have been standout outperformers versus most of the global markets, whether they are emerging markets or they are developed markets. We have outperformed them. And this is in a scenario where there has been significant headwind, whether on inflation or on geopolitical issues or liquidity tightening issues. On all of those, there have been significant headwinds, but India has been standing out as an outperformer. Now, I was comparing how our markets have performed versus some of the competing emerging markets. Take the BRIC countries or other emerging market lot, and you will be surprised to know that in dollar terms, as we stand today, we have outperformed all the BRIC countries on a 5, 10, 15, 20-year time horizon. And so also we have outperformed the emerging market set by a healthy margin over this period. And it is not a short margin by which we have outperformed, it has been quite a large margin. The situation was not always the same. When I look at the same data going back to 2013, and then I look at performance from 2013 September back to about 10 years, in all time horizons, we were underperformers. And in dollar terms, again. Now that tells you that something has changed on the ground that is leading to this outperformance by the Indian markets. Clearly, Indian markets or any markets don't have any agenda. They have only one agenda, which is rewarding competence and performance. And what the markets, by outperforming in India, are saying is that they're giving a thumbs up to the performance on the ground of the Indian economy and of the way this economy is structured to perform going forward as well. Let me give you one or two interesting examples of why this market is being given a thumbs up. Look at how our gross NPLs in the banking sector were starting 2012 going to 2017-18. They were on a rise, went up from about 2.5% all the way up to about 12% for the system. Now, when gross NPLs were rising, as a result of that, you had the credit growth contracting. From that 12% number, gross NPLs in the system have come down to under 6%. Clearly, a lot of cleanup in the banking sector has happened. And as many of you may know, in the recent times, last 2 fortnights, we have for the first time seen 15% credit growth, which again is quite a remarkable aspect given that over 7-8 years we've not touched this number. We have been in single digit growth over 7-8 years. So credit growth is picking up at a time like this when inflation globally is very high. Indian inflation is low in comparison. First time in 40 years, US inflation is higher than Indian inflation, which says a lot. Despite India being a large importer of oil, still India is on inflation doing so well. If we look at the trajectory of fiscal deficit as also the expectation that there will be greater indigenization, lower imports, and export is being incentivized. The expectation is that fiscal deficit as also trade deficit over a period of time will contract. And in the manufacturing sector, after nearly an 8 to 10 year period, we are seeing significant tailwinds within the country, which is good for job creation. Take all of this together, India as a result has outperformed most global markets. And even in this year, while India is about flat for the current year to date, if you look at the US market is down 20%. Indian currency has outperformed all currencies. Of course, it has depreciated versus the dollar, but the dollar has appreciated because it is a reserve currency. And in cases of risk off, the world moves toward dollar as a reserve currency. As a result, India is really standing out as a beacon of hope in a time of hopelessness. And next 5 years for this country, 5-10 years, are going to be a period where significant capacity creation will happen in this country. You will have companies moving from China to India and expanding their supply chains or duplicating their supply chains and getting a lot of business to India. Given where energy prices are in Europe, a lot of industries will want to move from Europe to India. So economic growth in India sees significant tailwinds as a result, and that will reflect in also how the Indian markets are poised for the investors to invest in. We remain quite positive on this country and on the prospects of our markets over the next 3 to 5 years. Of course, short-term volatility is something that investors will have to bear to take advantage of long-term wealth creation in this market. So the best time for this market is ahead, but don't get perturbed by short-term volatility in the markets as we are seeing in the recent 2-3 days. That is our view on this market. Many small cap companies will become mid caps will become large caps, and large caps will become even bigger in size. So that will be the nature of this market. And we are, as I mentioned earlier, we remain absolutely positive and confident that this is a market which will do well going forward. Uh, let's move to the presentation now, and we can take combined questions later on. Um, so, what is valuing growth? How do you value growth? And how is that important in wealth creation? Now, you may have heard of Charlie Munger, who is the partner of Warren Buffett and a long-time partner, very wise gentleman. His book, Poor Charlie's Almanac, is a must-read for any investor who's looking to invest in the markets. He says something very interesting. He says, to us, investing is the equivalent of going out and betting against the pari mutual system. We look for a horse with one chance in two of winning and which pays you 3 to 1. You're looking for a mispriced bet. That's what investing is, and you have to know enough to know whether the bet is mispriced. What he is essentially saying here is that if a horse has 1 in 2 chances of victory, and if you bet on that horse, for every rupee that you bet on it, you actually make 3 rupees. Then the bet is favored in your, I mean, is positioned in your favor, and such a bet is what you should take in horse racing. Let's look at this example in slightly more detail. Move ahead, please. Let's look at the concept of horse racing. In this, in horse racing, you are betting against other bettors. What that means is that assuming you have 3 horses in a race, and total bets placed are of rupees 35,000 rupees. On the first horse, you pay 20,000 rupees bet, which means if you pay 20,000, you will get 35,000, meaning 3.5 to 2 rupees. On 2 rupees, you will get 3.5 rupees. That is the odds that you are placing on horse 1. On horse 2, you bet 10,000, which means for every 1,000 rupees or 1 rupee invested, you will get 3.5 rupees. Hence, 1:3.5 payout for betting on this horse, and or that is the odds of victory that the markets are assigning on horse 2. And then on horse 3, if you bet 5,000 and you get 35,000 rupees in return, you're paying 1 rupee to get 7 rupees on this bet. So the odds are 14%, 1 by 7, on placing on horse 3. What happens in reality is that once in a while, horse 3 will be lighter, will be better suited for the conditions, will have rested well. So he may have, instead of a 14% chance of victory, he may have a 20% chance of victory. So actually, for a 1 in 5 sort of bet, meaning for a 20% chance of victory, you may get 1 in 7 payout, meaning for 5 rupees invested or 1 rupee invested, you may, or say 5,000 rupees invested, you may get 35,000 rupees. So here the odds are in your favor to invest or to back this horse. Other players are setting the price here, and it's not like there is a casino or there is some centralized agency which is setting the price. It is the bettors who are setting the price here, and the objective of an investor should be to find the most likely winner, and not the winner. I mean, basically, what people do is they look for the most likely winner, but actually, what one should look at is winners where the odds for you to make more money on the bet are there versus what you have bet on that horse. Skill lies in determining which most likely winner has a good price and which has a bad price. So as I explained here, for horse 3, if there is a 20% chance of victory, but the payout is 1:7, then actually you are getting better odds to bet on this horse and a better payout than what the odds suggest. That is what an investor should be looking at, or a bettor should be looking at in a trade-off like this. Let's move ahead. Let's extrapolate this to the markets. What is it that one should be doing when one looks at mispriced bets in the markets? Move ahead, please. Take the case of Century Ply, and this is only for illustration purposes. This is not a recommendation to buy or sell, nothing like that. This is just an illustration. In April 2020, Century Ply, we knew that the stock price on the exchanges was 110 rupees. Now, as we all know, a stock is the discounted value of future cash flows of a company. But at that time, all you know is the price, the listed price. So if you work backwards to figure out what are the cash flows that are built in into this price, the numbers at that time, April 2020, looked somewhat like this. That sales growth would be 5%, sustainable margins for this company would be 13%, and implied terminal growth rate would be zero, meaning long term, this company would have zero growth. This is the kind of expectation that was built in into the stock price. Now, it was our judgment to understand whether these expectations are real or not. If we look at the company's previous numbers, it was evident that the company has done over 15% margins for a very long period of time. Only in the last 5 years, growth had been tepid, but prior to that, growth was very strong, north of 15%. And this was a company in a sector, a leading company, leader of in building materials in a sector which is real estate, where growth would be for really decades together. We were only at a very nascent point of that growth in real estate. In fact, we were coming off a weak period. And so to expect that if real estate as a sector grows and yet this company will have zero growth was actually an overreach, an over expectation. And as a result, 110 rupees stock price looked like a price where growth was under expected, they were under expectations on growth. That what the street was expecting on growth was much lower than in reality what growth could come in a name like this. Fast forward 2 years, and you saw that the stock price was 700 rupees, and at that time, sales growth expectation 10 years was about 12%. Sustainable margins were about 19%. This is the expectation. And terminal growth rate expectation was about 6.5%. Now, if your belief was that at 0% growth was lower than expected, then clearly that belief got validated by the markets because over the next 2 years, not only did growth in the numbers come out to be far greater than what the expectation in April 2020 was, but even the stock price at that time indicated that terminal growth rate would be far greater than what it was expected in April 2020. And as a result, value got created. As this example suggests, and this is, of course, an example in the past, that you have to know enough to know that the bet is mispriced. If we knew that the market, that is the real estate market, was expected to grow far greater, and that the financial health of this company and the industry standing of this company is far greater than what the markets are expecting this company to do, then at 0% expectation of terminal growth and 110 rupees stock price, this company offered us significant opportunity because growth was mispriced. And if we could price that growth better, really so much value got created over a 2-year period. Nearly 7 times in 2 years is what you could have generated if you had valued growth well at that time. Let us look at some more examples. Move forward, please. Let's look at the first table on the left. This is Asian Paints and a small cap company at that time, APL Apollo Tubes. And let's look at how these companies exhibited growth on the ground. Asian Paints EPS in 2017 was 20 rupees. It went in 2020 to 29 rupees. which means a compounded growth of about 12.7%. And Asian Paints had a 5-year average ROE of 26%. Return on equity being an indicator of how strong the competitive advantage of a company is, indicated that Asian Paints had a strong competitive advantage reflected in high ROEs. APL Apollo Tubes, on the other hand, grew on a compounded basis by about 19%, far higher than Asian Paints, and it had a 5-year average ROE of 29%, again higher than Asian Paints. But look at the chart on the right. If you see there, you will notice that between October 2017 to February 2020, actually, APL Apollo Tubes did nothing in stock price appreciation. It was about flat, only about 8% growth, while Asian Paints was up 56% in the same period. In valuations, price to earnings terms, APL Apollo Tubes traded at 19 times price to earnings, while Asian Paints traded at 62 times price to earnings. Despite being an expensive name, Asian Paints did very well in this period. This was a phase where small and mid caps were being underappreciated. Growth in small and mid caps was underappreciated, while large caps were seeing overappreciation of their growth parameters. And that got reflected in the stock price, as you can see, despite APL Apollo doing far better on the ground, but still its growth was not reflected in the stock price because it was a small cap company by nature. Look at the second table, same situation between Infosys and Tata Elxsi. Tata Elxsi grew better, had a higher ROE, but for nearly a 3-year period, and we've taken the period of February 2020 consciously because this is prior to the COVID hit. Even prior to COVID hit, this stock did nothing, while you had Infosys being up 62% over the same period. And in valuation terms, more or less, both were equally valued by February 2020. But move ahead. As they say, Bhagwan ke ghar mein der hai, andher nahi hai. Markets belatedly started valuing growth properly. And if you look at the period 21-22, APL Apollo Tubes again accelerated growth. Asian Paints was again slightly tepid growth. And that and the markets noticed this because over this period of October 2017 to May 2022, stock was up nearly 5.5 and a quarter times. While if you looked at the same period and saw Asian Paints was up 2.5 times. So APL Apollo Tubes actually outperformed because of its growth. Eventually, only in that period of 17 to 20 it underperformed, but the markets gave a thumbs up when they started valuing growth properly, and the stock really rallied when that situation came. Same for Infosys and Tata Elxsi. Tata Elxsi went up 10 times, while Infosys was up over 3 times in the same period. So markets eventually value growth. Markets eventually value quality of business. It's just that in phases, markets are idiosyncratic and they will like certain segments of the market. Kabhi aisa hota hai ki markets will like IT sector. Then, as we know, in the last 6 months, IT sector is not being liked by the markets and it is an underperforming sector. Prior to that, you had PSU banks underperforming. Currently, PSU banks are outperforming. So these idiosyncrasies continue to happen in the markets. It is an analyst's judgment on how growth is being valued in the markets that determines whether you create wealth in the markets or not. And the same segment which may exhibit patchy growth at some point in time can be a value creator at later points in time if you can understand that now the growth is being underestimated for this segment of the market. As these examples show you that in 2017 to 20 period, you had small and mid caps being underrated while large caps were overrated. That flipped on its head because these growth companies actually got significantly valued correctly thereafter, and as a result, their stock prices started reflecting that. And so, valuing growth, my initial point that valuing growth is what helps in creating risk-adjusted returns and wealth in this market. Move ahead, please. Now, aside from growth, there are aspects to a business and to a stock which determine whether this business will generate wealth over a period of time or not. Now, the aspect of business quality as also of valuations, both those aspects need to be taken into account to understand whether this business will create value or not. For understanding the quality of a business, one needs to understand what the market opportunity is. Market opportunity should not be constraining for a business to grow. If you are in a market where the market size itself is 1,000 crore and you are 800 crore in revenue, then you have a very limited room for growth. But if you have 800 crore revenue for the company and the market size is 8,000 crores, then the room for you to grow is substantial. And that is something that we as investors need to keep in mind. We need to identify companies which have sustainable competitive advantages. These advantages can be in the form of a company being a cost leader or having a pricing power, or it having other competitive advantages like network effects, regulatory reasons for others to not come into their space. All of those lead to sustainable competitive advantages for a business, which allow for value to be created in these businesses. Think about it. When you buy a Peer soap, the soap probably is not manufactured by Hindustan Unilever, but that brand Peers is what you're buying. You're not buying the soap. And because Hindustan Unilever has that brand, it offers Hindustan Unilever the ability to price that brand higher whenever it so chooses. It would increase that price of that soap bar by ₹1 and no one would bat an eyelid. They would still buy Peers because they are used to using Peer soap, and so they would pay ₹1 extra. That is pricing power, and that gives you a sustainable competitive advantage. Superior returns on incremental capital. Now, when a company is investing its money in its business, it has the option of taking that money and investing it in a fixed deposit. The only reason that it would not invest in a fixed deposit and invest it in its own business is if the business would generate higher returns on that capital for that company than a fixed deposit would. And if it generates higher returns on capital, then that tells you that there is something about this company which allows it to generate these higher returns on capital, that customers are okay to pay that price for this company's product or service, which is why it generates higher return on capital. And that, again, is an indicator of how strong the business is, what are the product or service strengths of this business, what are the competitive advantages of this business. And as a result, it is our endeavor as analysts to seek that. Strong corporate governance and execution. There are times when you will identify companies which have patchy corporate governance and also execution. And so in certain phases, they will do well. At other times, they wouldn't. These companies can at best be trades. They cannot be long-term buys. While companies which have strong corporate governance and execution, those are companies which over a period of time will be wealth creators. And as a result, for us as analysts within Kotak PMS, this is the space that we are looking for. Companies where strong corporate governance is there and execution is flawless over a period of time and continuously so. On valuations, our endeavor is to identify companies which are trading at a discount to their intrinsic value. Now, as I had mentioned earlier, that when we identify businesses, we identify or try and assess the value of a business. What we are essentially trying to do is discounting future cash flows to today's value. Now, if we discount future cash flows and come to a reasonable value of say 100 rupees for a stock, and that stock trades at 120 rupees, then at 120 rupees we are overpaying for that business. Our endeavor is to identify companies which at 100 rupees are trading at value of 100 rupees are trading at 50, 60, 70 rupees. And as a result, by buying at 50, 60, 70 rupees, we are getting an element of a bargain, that we are paying less than what this company is truly worth. And, and that is the essence of valuation. And that's really what we try and identify in our portfolios. A combination of all these factors, along with consistent growth, is really what determines whether a company is going to generate wealth and a business is going to generate wealth for you over a period of time or not. But this is only half the work done. What is it that we seek to avoid? Move ahead, please. Basically, we seek to avoid bad capital allocation. There are companies which have weak balance sheets or weak corporate governance. These are companies which, again, do not create value consistently for investors, and where the risk of capital loss goes up. Now, take the case of a company with a weak balance sheet. If you have 100 crore net worth and you have 500 crore debt, if your EBITDA profits are 50 crore and your debt is 500 crore, then you are over leveraged. And in an environment like COVID, where for no fault of yours, the business environment itself freezes, then your ticker on that debt is still running, but your ability to service that debt is severely hampered. And as a result, this weak balance sheet leads to you going out of business. This is something that we want to avoid with a barge pull. Be away from it with a barge pull. And we believe that this is a recipe for disaster. It may be be delayed, but eventually, when the environment throws up challenges like this, these are the kind of companies which suffer the most. Weak corporate governance, again, most companies that have been successful over the years have been good capital allocators. They have allocated capital to their own businesses, and they have allocated capital in lines of business which are related to their own. They have not diversified into completely unrelated lines of business, and they have not allocated capital in areas where return on capital is not in line with the business of the company. Companies that generate high cash flows and then invest those monies in, say a pharma company which generates high return on equity and high cash flows, invests its cash flows in real estate, that company will find it hard to get valuations from the markets, because an investor is not investing in that company for that company to invest in real estate. Its core business is pharma, and it should stick to the pharma business and create value through the pharma business. If a company is doing the latter, that is investing in non-related businesses, then that is again, markets will punish that segment and that sort of capital allocation. Many times also you have questionable practices in how capital is allocated. Costs are inflated, capital expenditure is inflated, and markets read through that over a period of time. As a result, these companies do not create value. These are segments of the market we want to stay away from quite a disciplined manner. And we have been over the years been able to prove that these mistakes are not what we have done. Even to a minute level in our portfolios. And we take pride in that, in being able to identify companies where these practices are not suspect. So just by avoiding this, you reduce the chances of underperformance by a margin, which enhances, of course, your chance of outperformance. Move ahead, please. There are four strategies which we run within the PMS: the special situations and value strategy, fintech strategy, small and mid cap strategy, and the pharma and healthcare strategy. Strategies on the right are sectoral. The diversified strategies are on the left. The first strategy is, of course, the multi-cap strategy, and the second, as the name suggests, is the small and mid-cap strategy. Across the board, our strategies and our portfolios have been outperforming. They have, in fact, beaten peers over periods of time. And if we look ahead into the next slide, that will give you a picture of how these strategies have performed over a period of time. Clearly, our portfolios have done quite well, and they have been at the top rung of performance versus peers in various time horizons. In fact, many of these portfolios have significantly beaten even their benchmarks over long periods of time, and have been able to, in that sense, bring our philosophy of risk-adjusted returns for the benefit of our clients. So our strategies have, in fact, done quite well over a really long period of time. Move ahead. If we look at what we have spoken so far and extrapolate it to our portfolio, which is the special situations and value strategy, you will notice here that and look at the first row, the EPS CAGR of our portfolio between FY22 and 24 is expected to be 28%. And then if we come down to the price to earnings ratio, the price to earnings ratio of this portfolio is about 19.7 times, which means that the PEG of this ratio of this portfolio is about 0.7, price to earnings divided by the EPS. What this tells you is that in this portfolio, we are looking and we are identifying growth which is available at reasonable valuations. And as a result, valuations being far lower than the growth CAGR, the PEG ratio is 0.7 times. This is the essence of this portfolio, that we are looking to buy growth which is not priced in, and through that structuring of the portfolio in a manner like this, we are looking to generate risk-adjusted returns for our clients. Again, you will here see both ROEs as also debt to equity are quite favorable, very strong parameters for both those aspects. Nearly a debt-free portfolio and ROEs of over 20%. So we are able to identify businesses which grow well, trade reasonably, and have strong dynamics of capital, of returns on capital, and of the balance sheet strength. Move ahead, please. This is the structure of the portfolio. Strong, strong companies, top holdings, as you can see on the right. Sectoral diversification is evident on the left. Sectors which, in our judgment, do have tailwinds and which will grow well going forward, and almost equally distributed amongst large, small, and mid-cap segments of the market. It also offers reasonably large liquidity, with median market cap being about 24,000 crores and weighted average market cap being about 1,60,000 crores. So liquid portfolio offering strong parameters for outperformance going forward. Move ahead, please. The small and mid-cap portfolio is essentially looking for companies which today may be small, but that is the nature of the segment that they operate in. For instance, till recently, in the chemical sector, you had no large cap companies, only small and mid cap names. but that opportunity was only limited. As the opportunity rises, those companies may have the opportunity to become large and large cap companies as the market size increases. That's really what we are looking for. Favorable valuations, earnings potential, which is quite substantial, valuations re-rating, businesses having products and offerings which are simple and less complicated, and where, in our belief, organized sector, these companies being in the organized sector, will benefit from the shift from unorganized to organized. All of those are what we are seeking in this portfolio. And the portfolio, again, looks quite robust. Let's move forward. If you see here, the top holdings are self-explanatory, very quality, high quality companies in this portfolio. The small cap segment of holding is about 71%. Mid cap holdings are about 16%, and this portfolio offers us about a 25% cap for large cap holdings. And we hold one stock which is at about 9.8% in the large cap space. Even that stock has done very well for us. Median market cap is 5,600 crores, and sectors that we invest in are again sectors which have tailwinds for growth, and where, in our judgment, these tailwinds are not fully priced in. I am going to pause here since we've already taken a lot of time, and I will take questions here rather than going into the further two products. Thank you very much for your patience, and I look forward to your questions. Kamal, maybe we can take questions, please.
Right, Anshul, thank you so much. First of all, for giving such an insightful presentation. I had ran this poll while you were presenting that what is it that audience is liking the most. 60% mentioned the articulation has been, something that they have liked the most. So I must, mention that as a compliment. And also, obviously, the context and the concept that you were explaining was very insightful, very intuitive. So in that context, very first question that comes to my mind, if we have to value growth at present, how would you want to, value the expected growth in earnings starting from Indian economy, and then maybe percolating to major sectors like financial services, IT, and consumer discretionary?
Kamal, much of the answer also lies in your time horizon. Now, if your time horizon is the next 1 year, then given the uncertainty that one is seeing on the global level, and given that there is a monetary tightening cycle which is in the works, next 6 months maybe there is monetary tightening, which the endeavor of the US Fed is to enhance unemployment so that wage rates actually contract. If that is the case, it will lead to global trade seeing some bit of contraction. And if that happens, India cannot be insulated. And so in the next 1 year, you may see some of that growth hiccup even hitting the Indian market on account of linkages to the global, the general global markets. So short term, you may see those speed bumps come up in certain sectors which are more linked to the global environment. Particularly IT is a sector that comes to mind. Also, metals is another space where you may face similar sort of pressures. Now, if your time horizon is beyond this next 6 months to 1 year, and you're looking at a 3 to 5 year time horizon, and now it is ordained that Indian economy, which is today somewhere close to 3 trillion in GDP size, is going to be 5 trillion in size, and that our per capita income, which is $2,000, far lower than the developed world, is trending towards $3,000, $3,500 over the next 3 to 5 years. Now, if that is to be the case, then this incremental GDP that will be created will be through growth and will, in essence, make this a virtuous cycle. Because on a per capita basis, we have more income available in our pockets to spend. That spending will go into buying goods. Because there will be buying goods, there will be growth. Because there is growth, there will be further money in our pockets, and that cycle will become a virtuous cycle. Our belief is that we have only just started that cycle, and the kicker that a country gets when it moves from $2,000 to four, five, $6,000 in market cap, the kicker in market cap that a country gets is quite substantial. In the year 2000 is when I think China was at about $2,000, and today it is at about $10,000 per capita income, nearly 5 times our size. That journey for India is now starting, and we have seen how much wealth China has created in this period. We can estimate that that will also be, the path will be somewhat similar on wealth creation even for India. And in various sectors, we are only scraping the surface, whether it is financials, autos. I mean, if we sell 3 million vehicles, while if my understanding is correct, China sells over 15 million vehicles. Now, that tells you the difference in size. Real estate, we are only just scraping the surface. Chemicals, in APIs, China is 40% of the global market. India is only 3 to 4%. Now that can expand if it goes up to even 6%. That is an incremental 100% increase in the Indian market of APIs. So the point being that the Indian markets on growth are only just scraping the surface, and depending on your time horizon, that growth is getting priced in or not. I don't think the 5-year growth is getting priced in, but maybe the next 6 months growth is priced in. That's how an investor should look at this market.
Sure. So, the same question I'm wanting to ask and want you to answer in the context of India versus US. Because what happens when investors, try to base their investment thesis rather than focusing on earnings, the first focus is on price. And currently, it is being seen as in the beginning of this presentation you mentioned that an Indian market has relatively outperformed the other markets, especially the US. So there are investors who currently believe that because Indian equity markets have kind of not fallen and it has relatively outperformed, it is maybe a better time to diversify by investing in the US market. So to this obviously if one applies this argument on a stock, this doesn't hold good because ideally one should follow earnings and not the rise in or fall in price. So in the context of this overall webinar, how would you want to address this particular question where we are comparing India's expected growth and that compared to the valuations at present versus the US?
What happens is, Kamal, that many times, or the way to invest in the market there can be two ways. One is that you form an opinion about the market and you believe that the market has to behave in this fashion, and you act accordingly. The second is you take stimulus from the market, that is, you understand what the market is telling you and you behave accordingly. In the context of how we stand today, the stimulus is that the market is telling you. I mean, you look at the last 2 years, China has been a significant underperformer, India has been a significant outperformer versus China. Now, that is the market telling you that there is something happening on the ground, which is changing this dynamic that over the last 20 years, China was an outperformer, but now it is an underperformer. Similarly, if you look at the last 10 years, US markets in particular and developed markets in general have been outperforming emerging markets. But that trend is changing. Particularly in the context of India, it is changing. India's gap versus US is getting bridged. India was underperforming, but it is now catching up versus the US market. The question to ask is, what is it that the markets are seeing that we will see in due time? our belief is that if we take stimulus from the market, then markets tell you something, and you must take that message. The markets are telling us that growth in this country has legs for much longer, that there are a lot of stars which are getting aligned, that the reforms that have been done over the period 2014 to 18, 19 are now bearing fruit, that this country had very limited manufacturing, and as a result, job creation was limited. The PLI scheme of the current establishment is really working to enhance manufacturing in this country, and that will lead to growth for many years in the future. That India's currency is appreciating versus many competing currencies other than the US, because there is merit in buying Indian assets, which is what the FPIs are seeing, and as a result, the currency has been strong. And finally, if you look at also the MSCI indices, MSCI emerging markets, China over the last 2 years has seen their weight in MSCI emerging markets come down from nearly 38% down to 29%, while India's weight has gone from 7% to over 14%, nearly 2 times the weight that it was 2 years back. All of this is telling you a story that, uh, you know, without worrying about near-term volatility, if you're a 5-year investor, and you can be a SIP investor, you don't necessarily have to have lump sum investment in this market, then this is the market to bet on. And FPIs, FIIs have significant room to add to their weightage in India, which in our judgment is going to be really what we should be looking at, not really short-term price movements. If investing was so simple, then really just plotting things on the Excel sheet would tell you where to invest, where to take out money from. Clearly, investing is not so simple, and there is more depth to understanding these dynamics than plotting these near-term trends.
Sure. So in your presentation, in one of the slides, you had mentioned giving example comparing Asian Paints and APL Apollo, and you conveyed that despite the high valuations of Asian Paints, because markets was giving thumbs up to large cap, it being more I would say risk averse times and maybe less growth times versus small caps and mid caps at that point of time. So in that context, now in this current era of where the growth is back, maybe liquidity is less, and liquidity in the earlier era was more and growth was less. So what is your view? Would current and maybe present and ongoing journey of growth in market capitalization from say 3 trillion to 5 trillion in line with the growth in the economy in terms of GDP, what will participate more? What is that segment which will generate more wealth? Will it be mid cap, small caps, or the world of large caps?
Mid and small caps are by nature companies which have a smaller base, meaning a company which has 500 crore revenues and say market cap of 1500 crore, for that company to go from 500 crore to 2000 crore revenue over the next say 10 odd years is more likely than a company which has a revenue of 50,000 crore for it to go to 2 lakh crore, just on account of the base that that company has. And as a result, if you're in a growth environment, and that as they say, the tide itself is rising, which lifts all boats. If you're in such an environment, then the mid and small cap space will offer you outsized returns over a period of time. Of course, because they are less liquid, these segments of the markets will always, or the tendency of this segment to be more volatile is always going to be there. And that volatility is what an investor will have to bear to generate those outsized returns over a period of time. So Our belief is that small and mid caps will give you outsized returns over a period of time. If you're in quality small and mid cap names for a 5 to 10 year period, I can very safely say that these will be much greater wealth creators than the large caps, because that journey of a really outsized wealth creation in large caps has played out already. So that's of course, but it depends on what your objective is. Is your objective volatility minimization, or you are okay to bear volatility and your objective is outsized wealth creation? Depending on that, you choose one or the other segment.
Sure, Anshul. So, this is the last question, and before I ask this question, I'm just giving this disclaimer. We may be covering, a few stock names, but these are not to be construed as any kind of advice. This is only for an example to understand for education purposes. In one of the slides where you were trying to explain the special situations and value PMS, you had covered ICICI Bank and SBI, and
Correct.
these were mentioned as special situation oriented investment picks. Can you please explain, maybe over 5 minutes, we have last 5 minutes, that what is the special situation in ICICI Bank and SBI?
So let's take the case of ICICI Bank. And let's look at the time that we invested in this name, which was around 2016 and 17. Now, at that time, what had happened in this name was that your gross NPLs had gone from somewhere close to 2% to as high as 8%. They had sufficient capital, they had raised capital, but they were not being able to grow because they had a large weightage in corporate banking and they were smaller in retail banking. Retail and SME was a smaller segment for them. Corporate segment had slowed down and for the economy as a whole, and as a result, growth was becoming a challenge for this company. Also, their high NPLs were leading to growth challenges because if your house is on fire, you don't go out and play cricket. First, you put the house which is on fire, you douse the fire, and their house was on fire because of the gross NPLs. The second aspect was that you had loss of credibility because at the top management level, there was a lot of uncertainty in the bank because of various reasons, some related to even credibility of management and integrity. Now, that again led to energies of the management getting diverted towards unproductive activities. Our belief was that in their case, a management change was inevitable, and when that happened, it would bring new energies to the system. That at 8% gross NPLs, you had a peaking out of the company's gross NPL ratio, and finally, at with 17-18% capital adequacy, they had sufficient room to grow. But because of the history of this bank, they were trading at under 1 time price to book, which told us that much of this negativity is already priced in into this bank. Now, lo and behold, management change happened, and the company's high capital adequacy was allowing the company thereafter to go out and grow because gross NPLs had peaked. As a result of this situation, the bank started seeing an appreciation in its valuations, and price to book expanded quite materially from under 1 time to nearly 2.5 times price to book, 2 to 2.5 times. And this change in management was the trigger for that value creation to play out. Our assessment was that corporate restructuring will be a value creator for this company, and that played out quite well in this bank. Situation was similar for SBI. It was a PSU bank, and somewhat similar situation on the NPLs and growth numbers. The company had a lot of strengths. They had over 45% CASA ratio, low cost deposits, but that was not getting utilized because they were more a corporate banking bank, and they had they had issues of NPLs. The environment itself was slowing down. All of this led to valuations being quite reasonable. We took advantage of that, and we really unlocked value in this. Value got unlocked, and we benefited as a result. So again, these were the triggers that led to value unlocking in these names. And that's what we seek, company-specific triggers, corporate restructuring, which is happening within the company, which would unlock value for us.
Sure, Anshul, thank you so much for your time today. I think the context that you covered in terms of valuing growth in the context of wealth creation has been very, very insightfully covered. Thank you everyone for joining in. We will meet again next Friday with another topic, with another fund manager to cover another webinar. Thank you and have a nice weekend. Thank you everyone.
Thanks, Kamal. Thank you, everyone, for your patience and for making the time. It was a pleasure speaking with you. I hope we have been able to add value. Thank you again. Bye-bye.
Pleasure.